Hello and welcome to a new podcast from the Belt and Road Institute in Sweden, the first podcast for 2026. My name is Hussein Askary. Today is Saturday, January the 3rd. In our last podcast of 2025, we discussed that the year 2025 marked the end of a system, a 500-year system dominated by European and Western powers, when China challenged the United States on the tariffs issue and used its economic might to force the United States to reverse its decisions. At the same time, we said that there is no new system replacing that old system, but we can see the rudiments of a new system emerging with China and the Belt and Road Initiative, not exclusively, but generally in the center of such a development. We also discussed that such a period of a decline of a major power, a dominant hegemonic power, and the rise of other powers always fraught with danger and unexpected events because the dominant power does not want to give up its dominant position in the world. And today we woke up to the news that the United States, the president of the United States, decided to bomb and invade Venezuela, breaking international law, attacking a sovereign nation, but also breaking American constitutional law because he did not have the approval of Congress. We don't know where that development is leading, but it's typical of this period of time. Our discussion today will deal with the emergence of what we can call the beginning of a new multinodal or multipolar or multilateral financial and economic system and monetary system. And to discuss that, we have a very, very special guest with us today, Mrs. Kathleen Tyson, a monetary and financial expert with a long experience in international institutions, and also the author of several books, but the latest and most important is called The Multicurrency Mercantilism. Thank you, Kathleen, for taking the time to be with us today.
Thank you very much for inviting me.
Well, it's a pleasure. I didn't want to explain more about your background, your career, your work. I would like you to introduce yourself to our audience.
Right. I started as a wee small central banker at the Federal Reserve Bank of New York in 1986. I was there in 1987 for the market crash when the markets crashed by 40%, which is largely driven by a dynamic that developed between derivatives and the securities markets in New York. So after that, I was actually in the room for the first Greenspan put, yay. And after that, I was put as a founder member on the Settlement System Studies Group to figure out the dynamics and the interconnections in various nodes of liquidity and trading in the American markets and in global markets. So from there, I came to London to supervise the London Stock Exchange dematerialize British securities, which were then physical paper certificates, and oversee Euroclear and Clearstream and SWIFT and Bloomberg and Reuters, the global infrastructure of capital markets. After 5 years of that, I went to Clearstream to start building new infrastructure because I could see there were gaps. So in the 2 years I was at Clearstream, 2.5 years, I've been giving birth to both sons. I managed to co-invent tri-party repo, co-invent optimized derivatives margin for over-the-counter markets, and get US Treasuries into Clearstream for global use as securities collateral. And that created the global repo markets. Then I saw they were going to build CLS Bank for foreign exchange settlement. When I saw the banner headline in the FT, I said, I'm going to build that. And I did. So I worked with both the founding banks of CLS on the governance and then IBM on the operating solution. And CLS now clears 4 to 7 trillion a day in foreign exchange settlements in 18 currencies. So then I became a consultant on other global markets infrastructure, worked with SWIFT, was out there to found Dubai International Financial Center, modernized LCH ClearNet and other global infrastructure, and modernized 14 central banks. So I'm a plumber, and I'm behind a lot of plumbing that banks use every day.
Okay, we will get back. I did not mention that you are speaking to us from the UK, from London, right? Okay. Yeah, no, I will ask you, you can explain what your book, Multi-Currency Mercantilism, is about during our discussion, because that's really something which very few people have a clear handle on. And actually, you predicted already when you were writing your book 3 years ago that there is something new coming to town in terms of the dominance of the dollar in international trade and other financial and monetary relations. But I would like to discuss, first of all, the question of money, because many people have funny ideas about money, because it is believed that money has an intrinsic value, a life of its own, out of it, its own existence. It has a certain value. But there are common definitions that money is a store of value, it is a medium of exchange, and unit of account. The store of value is like when people have money, they keep it in a bank and in money terms, dollar or whatever. Today is we're going to talk a lot about the dollar, or like they have gold or something else where they store the value in the bank. Medium of exchange, which will be about a lot of what we discuss, is a question of trade, and your book Mercantilism is pertaining to trade, I think. And unit of account is also interesting because many things in the world are priced in dollar. And but there's also this problem that money is created. It's not doesn't exist out of itself. Its value is not intrinsic, and there are conditions and context how the money is created and where it is deployed and what is its effect. And this brings us also to the question of credit loans, where investments are made, whether it's governments, corporations, or individuals. They take a credit to invest in something which they believe will give back something in terms of productivity, which it brings us also into the Belt and Road Initiative, the Global South investment in infrastructure, and how to finance infrastructure and economic development. So these are the three areas we would like to discuss. But you are an insider. You are not an observer. You worked inside the transatlantic system, the so-called Bretton Woods system. You call yourself a plumber. You have created instruments and infrastructure within that system, but now you think that system is not functioning in a way. There's something coming up to replace it, which is more productive and better for the world, for the economic conditions of peoples. So you know the background of the whole Bretton Woods system, how it evolved and how it is winding down. So please let our audience hear a bit of the background you have
Right.
studied and experienced.
Well, Bretton Woods was born in wartime when the United States took the initiative to more or less force by blackmail on the Allies a new monetary system with the United States and the US dollar at the core. The Allies were completely dependent on the United States for many supplies, for munitions, for equipment, for food, and 44 states in Bretton Woods, a conference center, signed off on a treaty that bound them after the war to using US dollar as the principal currency for settlement in the world. And then dollar was then fixed in gold terms at $35 per ounce. And that created the security for the world to use it because it was redeemable for gold, so that they would have confidence that every dollar was worth $35 an ounce of gold. And that worked pretty well, except that the United States was addicted to wars. It found them very profitable, frankly. And so in the 70s, the United States was running hot. It was at war in Vietnam. It was creating a lot more debt. And it was also creating social reforms. So welfare, Medicare, social reforms that were very expensive domestically. Oh, building out the US highway system, building all kinds of infrastructure. And that ran the economy very hot. And because of the amount of debt that was being created, that nobody was very certain would be productive, especially the social welfare spending. It was very uncertain whether that would be productive. Countries became uncomfortable with the accumulation of debt. And France, Italy, Germany, and Britain started to want gold in exchange for their surplus dollars. With some of these countries, the United States was just able to say no. It had the governor of the German Bundesbank sign a commitment that he would never ask for gold again. But with other countries, and particularly France, they were not able to impose that they would never ask for gold again. And the system became slightly unstable. So in 1971, Richard Nixon unilaterally, without consulting the Allies, after a weekend discussing it with his advisors, revoked the exchange of dollars for gold temporarily. It turned out to be permanent. From that point, overnight, we had fiat currencies that were not fixed to any secure value. They were not fixed in dollars and they were not fixed in gold. And we had a chaotic period where things were very volatile. We didn't even have mechanisms really for foreign exchange trading that were highly developed. So the whole thing became rather unsettling for the world. Henry Kissinger and the Treasury. Anyway, they came up with the idea, we need to stabilize things by fixing the dollar to something that has global demand. And they settled on oil, because everybody uses and burns oil. So it would create sustained demand if they could fix dollars in oil. And so they went around the Middle East and essentially made countries offers they couldn't refuse, that they would only sell their oil for dollars. And if they did not only sell their oil for dollars, then the ruler would be killed, his family would be killed, and if necessary, they would occupy the oil fields with the military. Most leaders signed. And that held pretty well for a couple of decades, until you had leaders like Saddam Hussein and Gaddafi wanting to sell their oil in other currencies. Well, they both ended up dead, their families ended up dead, and America occupied the oil fields, just as they said they would. But it brought more criticism of the system and of the aggression and violence that was required to maintain the system. And so it destabilized things. And more countries began looking at ways to move away from dollar, move away from being subject to coercion.
There are two issues I want to ask you. Is that there are other institutions within the Bretton Woods, the World Bank and the IMF, who have increasingly been very gaining a lot of power, especially over developing nations, nations of the global South, dictating to them how to run their economies, basically, and without any avail, so to speak. You often mention the case of Pakistan, which keeps getting advice and following advice from the World Bank and IMF, but they never managed to solve the problems. There's also the problem in the Western system is that we went into a process of financialization since the Nixon period, because money became a commodity in itself, and you could make more money in the financial markets than in investing in infrastructure, industry, and productive investments. And that created a massive financial sector, which is now, God knows, maybe 1,000 times larger than the real economy. Might have been through many shocks and crises, like the global financial crisis of 2007, 2008. People talking about a renewed new global financial crisis because that system is inflated. Like even the AI bubble now. Everybody's talking about it. So there was this paradigm shift away from industrialization, away from production into financialization and consumerism, while moving a lot of the production to developing nations, outsourcing and so on. That was also so both the IMF and World Bank and Bretton Woods systems are weakening, but the economic might of the Western powers is weakening and being exposed as a major bubble, so to speak, in
Mm,
that same process where China was rising and other nations were rising economically.
yes. What's interest There was a very interesting paper from the Bank for International Settlements last year, which looked at the growth in global credit in recent years. And actually, the amount of private credit is declining. The amount of government credit is increasing. And in many cases, it's not clear. As you say, originally, lending was supposed to be for productive purposes where the production would repay the loan. But with governments, spending on militaries is not productive. Uh, it doesn't generally create a great return. Often it's a negative return. Spending on social welfare, on retirement, on healthcare for aging populations doesn't generally produce a positive return. It's a good thing to do, but if the nation is deindustrialized, and we're rapidly seeing deindustrialization in Germany, in Italy, in France, in the United States, even we've lost a lot of industry in the last year, and certainly in Britain. Britain's seriously deindustrialized since Brexit. It's hard to see where the productivity is going to come from. And so there's a potential for an increase in sovereign debt while private credit is not doing well, uh, to, to, to squeeze out private credit and lead to less productive economies in future. Nobody knows exactly how this plays out, but it is a relatively new feature in the global economy. On the IMF and World Bank, at the end of World War II, Asia was destroyed, Europe was destroyed, and the United States was last man standing, having profited hugely from the war. They ended up just being, because of their isolation, the strongest economy in the world, with more than half the world's gold, half the world's GDP, um, standing industries that were still productive after the war, so they could shift from making tanks to making cars to making trucks. And they did extraordinarily well for a few decades. And then, as you say, they started to financialize, and it became more profitable to speculate in investments than to actually invest. And we've seen that particularly in recent years as companies, if they get money, they do share buybacks. They don't bother expanding research and development or expanding industrial capacity. They just do a share buyback, and that boosts the share. We're in the stage now where the underlying basis for markets is becoming questionable. What are they for? Are they accurate at price discovery? Are they accurate at predicting productive investment, predicting returns on capital? And we're in a sort of transition phase where we're not really sure anymore.
Yeah.
But at the same time,
These
we have a huge bubble.
these corporations who create these bubbles, and the banks who loan the money to, they rely on the state because they are too big to fail. We saw the bailout, like it's 17 to 20 trillion dollars since 2008. The U.S. Federal Reserve, the European Central Bank, the Bank of England, and Bank of Japan pumped trillions and trillions of dollars, and they even got help from the Gulf Cooperation Council countries to bail out banks in Britain and the United States and also in Europe. So they can rely on the state of pumping in, printing monies basically to do that. It's fascinating because I was looking at China since the financial crisis also created about 17 to 18 trillion dollars.
I was going to say China has actually been leading in creation of money.
Yeah, but they were investing that money in building 50,000 kilometers of high-speed rail, a space program, massive industries,
And
all
Belt and
kinds of,
Road.
and also the Belt and Road Initiative, real investment, and so on. So
Yeah.
it's an enormous difference between the two. But how far can states, the United States, Britain, the EU, and Japan borrow and pump money into the market to keep this bubble going?
We don't know. I mean, this is the thing about bubbles, is it's very difficult to know um, when they're expanding, at what point, what breaks it. This is why they're allowed to sustain for so long, because the bursting of the bubble is so painful that no policymaker or politician wants to be responsible. I think China is very interesting, and it's the only case in history of a property bubble being deflated while not collapsing the real economy. So that China deflated its property bubble over a period of, what, 5-6 years, while the economy continued to grow, not at 8%, but at 5%, and continued to expand. And that's a unique achievement. It's really something worth studying, because other countries tend to let the property bubbles run until they burst, causing wider harm and deflation. That's Japan. Obviously, Japan's had 30 years of zero growth since it started quantitative easing 3 decades ago. It's been a growth killer because they protected the existing companies, the existing banks, the existing properties, and never really recovered. Europe has had zero growth for 15 years, since about 2007, so a bit longer. United States manages to sustain growth, but that's largely by buying it from the rest of the world. So acquiring profitable companies or getting them to list on NASDAQ, and then getting the rents from profitable companies wherever they are, while the US economy has been largely hollowed out. So it's an interesting time to watch monetary dynamics, because you do get the sense that this doesn't go on forever.
Now, this brings us to your book, because there's a reason you wrote your book,
Indeed.
Multicurrency Mercantilism. What is the story, so to speak?
Okay. Well, 9th December 2022, I watched 2 huge events that were not covered in Western media. In the morning, Xi Jinping, while on a state visit to Riyadh in Saudi Arabia, made a speech to camera saying that Palestine needs to be addressed. It needs to be a state, 1967 borders, capital at Jerusalem. Not covered in any Western media, only covered in Middle East press. And then in the afternoon, he stood there with the 6 heads of the Gulf Cooperation Council states, and he invited them to trade oil and gas in Shanghai for yuan. And I went, oh my gosh, that's the end of Bretton Woods. The Bretton Woods II system we've had since 1971, when Nixon repudiated gold redemptions, is over, because now we're going to have trading of oil and gas in renminbi, in yuan. And I actually wrote a commentary published on our website about Bretton Woods ended today. But guess what? Wasn't covered in Reuters or Bloomberg or the Wall Street Journal or the Financial Times or the Economist. Zero coverage. And after 2 weeks of watching them ignore it, I thought, they're going to make huge policy mistakes because they don't understand what's happening. If we're too timid to even discuss what's happening in the media, we're going to make big mistakes. And so I started writing Multicurrency Mercantilism, so that at least there'd be a handbook when they've started to figure out what's going on. And basically, I'll just summarize very, very quickly. The alternative to the dollar is the dollar and all other currencies and commodities. So the alternative to the dollar is the ruble, the yuan, the rand, the UAE dinar, Malaysian ringgit. It doesn't matter. The alternative to the dollar is any other currency that 2 parties to a transaction are willing to accept, and also gold, oil, lately in the last few weeks, silver, and other commodities that can be a store of value, or at least are required as an economic input. Stable transition. Now, here's where things get edgy, because at the time I wrote it in 2022, 23, I said that the transition can be stable unless there's wider war. Normally, when there's a transition from a hegemonic currency to a rival currency, there are world wars. And we've had 500 years of that. Dollar took over from sterling after World War I, and then settled its status as the dominant hegemonic currency after World War II. And the real question was, are we going to have world war? Now, the United States clearly would give world war. They want to. They would love to crush all rivals. They would love to destroy China. But it's no longer clear that they can, because they've been losing power and they are so dependent on China, even for their military. So the real question, they're attacking a lot of weak players. Obviously, in just the last week, they've bombed Venezuela and Nigeria is their ally. It's the most pro-American state in Africa. But let's just bomb you anyway. And of course, last year they bombed, I think, 8 countries. So they are trying to preserve their hegemony with violence, but it's not clear anywhere anymore whether that's going to hold, because they are now economically vulnerable, and there are things that other states could do that could perhaps curb their tendency to lash out. So that's a big question mark on stable transition. No new hegemon. There, I'm pretty convinced I got it right. China doesn't want to be a hegemon. They're not insisting anybody use yuan. They invite them to use it, but if they don't want to use it, they don't have to. So that's a pretty good call back then. Globalization accelerates. Now, the last 3 years, all you've heard from the West, from G7 economists, is fragmentation erodes the economy. Fragmentation hurts the economy. But what if the 40% of the global economy that was frozen by US sanctions now has the optionality to use any other currency? Then you're taking that 40% of the economy in Iran, Russia, that's been frozen out, and you're integrating them back with the global economy, and they're trading at speed. So Russia's doing huge amounts of business with India and China, selling oil and gas to them. Iran is doing huge amounts of business with China. Their -- 1 buyer for oil. Venezuela, which was also under sanctions, was selling most of its oil to China before it got invaded yesterday. But globalization has actually accelerated because so many countries that were frozen out got reintegrated. The angel paradox. This guy is named for Sir Norman Angel, who won the 1932 Peace Prize, Nobel Peace Prize, for the insight in the Great Illusion that when two developed, interdependent economies go to war and they economically sanction one another, the sanctioner will sustain as much harm as the sanctioned. Oh my gosh, it's been proved again and again and again. What's interesting now is we've seen with Russia that you can change that dynamic by becoming sovereign and not dependent. So since 2014, Russia could see the direction of travel after 2014, could see it was going to be sanctioned and its economy put out of existence, and began responding by making itself not dependent on other economies, by making itself sovereign. And so we've had 19 rounds of sanctions from Europe on Russia, and Russia's just gone and emerged stronger. So they're now the 4th largest economy in the world. Ruble is the best performing currency of 2025. And Russia's not dependent on Europe for anything anymore. Not for capital, not for technology, not for management, not for anything. And so Europe has hurt itself again and again and again 19 times. Europe is much weaker, has lost growth, has lost industrial capacity because energy is 35% more expensive. And so we see angel paradox just very, very clearly in the last few years in Europe.
Yeah, you mentioned the fact that you worked with SWIFT because Russia made itself also independent of the SWIFT system, which is the system which enables transactions across borders, and it's completely controlled by the United States and Western
Well,
forces.
actually, they took a
But
huge
Russia
hit.
created its own cross-border trade, currency exchange. China created the CIPS, the China Interbank uh,
Payment system.
payment system. So how does that play into this whole new dynamic?
Yes. Well, actually, Russia did not expect to get cut out of SWIFT. They were surprised by that. And they had to react dynamically very, very quickly. So the first thing they did was say, right, if you want our oil and gas, you have to pay for it in ruble. And that stabilized the demand for ruble. And it gave them a little bit of time, the first year that they had this requirement on, to bring MERS up to a global spec and get MERS membership expand. MERS is it's the Russian payment system. It's equivalent of CIPS. And so they got MERS globalized in that first year out to a lot of banks. They never disclosed how many. They stopped publishing who was a member of MERS so that they couldn't be hit with sanctions, with secondary sanctions. And it took them the year to make the transition, but they did a very effective job. They were blessed in having the governor Nebelina at the Central Bank of the Russian Federation. She is amazing. She did a terrific job in stabilizing a very, very difficult situation. But yeah, so angel paradox holds true. Next chapter, resiliency, stability, and inflation. If you're doing trade in your own currency and your trade partners' currencies, you have much more predictability on flows because you know what you buy year after year in trade, you know what you sell year after year in trade, and you can roughly guess how to balance. And so you can actually end up with a much more resilient economy by getting away from hegemonic currencies like dollar and euro, where the exchange rate volatility can hurt you very, very quickly, can destabilize the economy very quickly. And that can bring inflation down and allow you a much more stable path of growth in the long run. And we're beginning to see this play out now as more countries have moved to local currency trade since 2022.
So the question here is not to replace the dollar, but to use the local currencies and the multiple currencies, both to avoid the fluctuations in the U.S. system, on the Western system, to avoid sanctions, to avoid, all kinds of problems. So also it's much cheaper and quicker.
Yes. It will normally go through correspondent banks in the sending country and receiving country, and it'll be like 5 days before it gets to your account. There are probably going to be 12 SWIFT messages. Each will have a charge for it. Various transaction instruction and confirmation messages. So it can be quite expensive. Whereas if you use, I think CIPS is about less than 2% of the cost of a SWIFT transaction. So very much lower cost, lower time lag to get the deal done. And SWIFT, let's see, CIPS, Chinese Interbank Payment System now has, I believe, 1,800 banks connected to it now, both directly and indirectly.
So they can trade with each other, like Brazil and China. They can trade with each other using their own currencies, but also at a much lower cost, much more safer. But also you mentioned the Gulf countries because the speech President Xi Jinping gave. I was in Baghdad then talking to people in the Iraqi government. I also have used that speech many, many times because people don't notice. He mentioned the question of using, the Shanghai, petroleum exchange, but also he suggested financial cooperation between the countries. There were 5 points, but all related to real trade, real investments, real economic development. But I think this was an amazing moment, which was missed by many people.
It was amazing, and you're right. I mean, after that speech, he's Xi and the Saudi king signed, I think it was 42 cooperation agreements,
right,
for various aspects of economic cooperation going forward. And so a lot of Saudi investment is now going into China, into areas where the Saudis have unique expertise, like petrochemicals cooperation and you know, various byproducts that oil is used for,
Yeah.
cooperation, plastics,
Yeah,
whatever.
I've seen in Beijing outside my hotel. I was eating breakfast. There was a billboard. It was advertising for Aramco
Yes.
petrochemical in Beijing, in the capital of Beijing. And
Yeah.
also, many people have still this idea that the Gulf Cooperation Council countries, like especially Saudi Arabia, these are captives of the United States. They cannot do anything on their own. It's not true because the oil crash in 2014, 2016, and 2020 taught these nations a very, very, big lesson because they were almost on
Yeah.
the verge of bankruptcy and they have to diversify their economy. So they're
Yeah.
investing in industrial development and infrastructure. And who's there to support? It's China. And that's where things are actually going. There are even electric vehicle and buses production in Saudi Arabia. Lenovo computer company just built a plant in Saudi Arabia, paid for the Saudi Sovereign Wealth Fund, the
Yeah.
PIF, buying bonds in the Lenovo market. So although the oil is not traded in yuan, there are other ways where the oil is being traded for real goods, real investments. And this is where actually the whole China policy and the Belt and Road comes into play. But I mean, there are also many other examples you give in your book about transactions being conducted, like including barter. You don't necessarily need the currency, but you can use other products because that's the issue we discussed in the beginning. What is money for? How do you deploy money to increase productivity? And if you can do it by other means, that's even fine.
Yeah. It's very true. And Iraq has been selling its oil, not all of, I don't think it's raw crude, but various parts of distillates to Iran in exchange for electricity,
Right.
because it still hasn't managed to rebuild the capacity it had pre-war 22 years ago.
Yeah.
So lots of deals can be done that are beneficial to both parties. And this is what's been inspirational, I think, about Belt and Road and about other developments in the last 2 decades, is countries now look for optionality. They look for what's possible instead of just defaulting to dollars.
Yeah. There is one of the things which we have been following, I mean, especially since the third Belt and Road Forum, which I and my colleague attended in Beijing, 2023. President Xi Jinping said that the new level of the Belt and Road Cooperation is in modernization and industrialization. And even before that, we've seen industrial parks popping up in West Asia, in Africa. Egypt is a great example, the Suez Canal economic area, Ethiopia, Tanzania, everywhere in Africa, you have industrial parks. Like in Nigeria this year, both China and the UAE agreed with Nigeria to build a $22 billion oil and gas petrochemicals complex. This is the biggest in the world.
Which is probably what got Nigeria bombed last week.
Maybe they want to put pressure on Nigeria to stop its cooperation, but this is unstoppable because those nations are getting an idea that they can not only they can use their raw materials, whether it's oil, lithium, copper, chrome, whatever, to build industries in their own countries and increase the added value. And I think this is the trend into the future. And I think you pointed that in your book that this is where things are going. And the Chinese are very open with sharing technology with others. I mean, they are not simply outsourcing jobs to Africa, but they are really building high-tech, industries in Africa. Uh,
Yes, transient cell phones are now the dominant phone in Africa, and they're made in Nigeria, in Ethiopia, with Ethiopian workforce and Ethiopian management. The design has remained in China, but the business is in Ethiopia. BYD. I was very surprised in Cairo in December 2024 to see that about 1/3 of the taxis in Cairo were BYD. So I asked the driver about it, and he said, "Oh yeah, they built a factory here in 2022."
right.
And then this year, or at the beginning of 2025, 3 more EV companies from China agreed contracts to build new factories in Egypt.
Yeah, one
So
of the factories building electric buses, double decker, are exported to England.
yeah, yeah,
Built in Egypt.
it's wonderful to see. And every town we went to in Egypt had a new hospital and a new school,
Yeah,
and you could really see the country prospering. And in the south, behind Aswan, on what is effectively just military land, they have put in canals and irrigation rigs, and they're actually growing agriculture in the desert
right.
on the model that China proved practical.
That's exactly. This is one of the big issues for Egypt and most African countries because they are so dependent on importing food that most of the financial resources are going there. They even borrow money to
Yes.
buy grains,
Well,
and
this
cooking
is
oil.
Egypt was hugely dependent for oil and grains on Ukraine.
Right.
So it was only when Ukraine, when the special military operation began in February 22, uh, that Egypt got a huge shock. And then they began looking again for optionality. That's the key word. What can we do?
Yeah,
And China's like, we'll help you grow your own food
exactly.
because they
China
already have
doesn't
the
want to make
technology.
money from selling food to people. It can sell agricultural machinery and technology instead at higher value. Uh,
Yes.
yeah. No, that's a fascinating development because this is the kind of changes that it's not only China is rising because we have a completely new dynamic going on in global South. Like we have seen the ASEAN growing. Now we see West Asia and Africa also emerging. This is the subject of my book, which is actually completed now. We'll publish it soon, extending the new Silk Road to West Asia and Africa. As the second edition, it will be published in English and Chinese at the same time this month. But you see this massive, one of the big events of last year was actually that Egypt and Tanzania, because all European, American, other construction companies refused to build a dam, a hydropower dam in Tanzania, the Julius Nyerere Dam, an Egyptian company built the dam. So two African countries for the first time built a massive 2,000 megawatt hydropower plant. Of course, the turbines were imported from China. They cannot produce turbines yet. But the whole structure, the conveyor lines, the materials used in the building, all were built by the Egyptian and Tanzanian company. So
And
this is
what's
kind of,
fascinating is the
yeah,
IMF refused to finance that dam.
yeah,
So they self-financed it against the proceeds of the generation of electricity, which are
exactly.
fairly predictable.
Yeah.
Yeah.
Same with
And
the
yeah,
Grand Renaissance Dam in Ethiopia. This brings us also to the final part of our discussion is that how to generate finance credit for infrastructure, which China has done brilliantly, but it's not enough. What China has done is fantastic. It's a great model. But the needs for infrastructure financing in Asia and in Africa are like maybe 20 times larger, but it's a good model. But we have that nations, what you talk about sovereignty, they can generate their own finances. We have Ethiopia, they finance their own Grand Renaissance Dam. Egypt, when they wanted to build the Suez Canal, they also issued Suez Canal Authority bonds. Instead of getting $2 billion, the Egyptian people bought what is worth $8 billion. I mean, Egypt for many, many years was negotiating with the IMF to get a $3 billion loan, but the Egyptian people offered $8 billion to the government in 10 days.
yeah.
It's just amazing because people in those countries, in many countries, because of financial, political insecurity, they take their money, keep it at home, or they buy dollars or gold and keep it at home. And that's a huge loss for the economy because it's not circulated in the economy. And so, therefore, nations can actually start their own, what I call development banks or wealth funds because there is money in every country but people are keeping it away from the economic activity.
We're seeing a lot of new structures emerge, and new possibilities. Burkina Faso and managed to get itself a gold refinery last year. I think they're on their third tomato processing plant, canning plant, and these were all domestically financed. They've realized we have the resources. Why should we ship our tomatoes to France to buy back the paste at 8 times the cost when we can just can the tomatoes here and keep the value inside the country and generate more capital that we can then broaden the investment? So that model is now, it's actually, when I'm working on something called the money game, which will teach the theory of central banking and finance and industrial development in a commonwealth. And that is actually the theory of the game, that you can concentrate the capital within the economy, recirculate it, and build up joint prosperity in the whole commonwealth.
That's fascinating. We have the similar cases like in Nigeria, the Dangote refinery. Now, finally, Nigeria, after 50 years, because they used to export the crude oil for $50 a barrel, but they import refined products from the West for $100 a barrel, which is an enormous loss. And there are many such cases like nations who have lithium and other. They want to build electric vehicle batteries and lithium battery factories in their home countries. Zimbabwe banned the export of raw lithium, and they asked investors if they want to invest in building plants to process the lithium and make better. They are welcome. Only the Chinese accepted that deal.
Yes,
So, but this way you can generate higher value, you can generate income and reinvest that income in your own development process. That's
exactly.
your point.
Exactly. You grow the pool of capital, and therefore what's possible in terms of the industrialization. This is it's actually Sir Norman Angell came up with the money game a long time ago, almost a century ago. So we're working to adapt it, but it's going to be great fun because the principles are basically the principles we're still being seen uh, in emerging countries, where they are looking at what can we do with what we have, rather than asking for another loan from the IMF or the World Bank, or capital from foreign investors that will see the rents all go offshore.
Mhm. And this is also, there are, I've myself seen this and talked to people behind. Like Iraq in 2019, they signed an agreement under Dr. Adel Abdel Mahdi, the prime minister, with China, whereby, I mean, China is the largest importer of Iraqi oil. They buy 1 million barrels of oil a day anyway. So the idea was to take 100,000 of those 1 million, 10%, and exchange it for infrastructure projects. But
Mm-hmm.
the Chinese would not only take the oil and exchange it, they would add from Chinese banks 6 times more to the original and start infrastructure projects like $10 billion together, 1.5 billion from Iraq, 8.5 billion from Chinese banks insured by the Chinese Export and Credit Insurance Corporation, Sinosure. But Iraq then will pay back the over 20 years, like just
Yes.
100,000 barrels of oil every day. So Iraq, which is financially stripped, could finance large scale infrastructure all over the country without having to borrow money.
Yes. And Iraq needs to do this because its dollars get trapped in the Federal Reserve Bank of New York. Um,
This is another terrible story because
yes.
Iraqi oil money does not go to Iraq. It goes to a Federal Reserve Bank account in the United States, controlled by the American president by decree.
I know the officer of the New York Fed who set that up in 2003.
Yeah, yeah. And it's every year the American president issues the executive order 13303 or renews it every year to keep control of the Iraqi money, which is terrible. So anyway, I mean, there are many solutions for developing nations to get financing for infrastructure. I mean, I don't think there's anything wrong with borrowing from China. They need to borrow even more because Chinese loans are very long time, 20 to 25 years at 2% interest rate adjusted to LIBOR system. And also they are deployed for a productive investment
Yes.
because many nations end up in a debt trap because they borrow money to pay old debt, uh, which is, gets them addicted to borrowing more at higher interest.
Yeah.
There are many such cases.
Yeah. It can be it's a very sad cycle. And if the original loan was not invested productively, which often it wasn't, it was used for corruption, for self profit. then the country never really escapes from the trap. Where because China's banks tend to actually insist that projects are correctly scoped and correctly managed, they tend to have much more positive outcomes.
Right.
They actually do turn into productive, cash generating assets that can service the debts and
Right.
reduce the debts and pay them off, which is even
Exactly.
better.
Exactly. That's the difference. I mean, we have many cases, but like last year, because there's this whole thing about the China debt trap. We have written about it a lot. I have made videos. We completely debunked it. Others have done that. We're not going to go through that. But there was this general outcry every time a country is in a financial problem, like Kenya last year, they had to pay back $2 billion in bonds,
Mm,
sovereign bonds, euro bonds. They had borrowed the money from Western bondholders, investment in funds like Black Rock and others, Ashmore, Aberdeen, and England. But everybody was talking about China, but not talking about these other where Kenya's debt to China is only 15% of all its external debt.
yeah,
More than 50% is by World Bank, IMF, and the rest by these private bondholders. But to get money to pay back that, uh, Kenya had to borrow $1.5 billion again from the same bondholders, but this time at 11% interest rate for a shorter period of 5 years instead of the previous 6% and 7 years bond. And the IMF said, oh, this is great. Now we can help you, but you have to cut subsidies, you have to raise the taxes, and there are demonstrations all over Kenya. China had nothing to do with that.
no.
And this is
It was the same thing with the IMF's most recent facility to Pakistan. They made them borrow at 11%, I think it was Standard Chartered Bank, in order to secure what they called reserves um, that would allow the IMF to extend a further debt to repay the previous IMF debts. And the whole cycle becomes abusive,
right.
and it's a trap. And
Also,
uh,
the
I'm
conditions,
glad to see that there are other models coming forward where
right,
the finance is much lower rate, much longer term, because the difference between Europe, which can borrow at a little over 1%, and Pakistan or Kenya, where they have to borrow 11%, Pakistan or Kenya can never hope to grow their way out of the trap. And um, it's it's actually something I've felt very strongly about since I was quite young. I was a teenager when I decided I was going to go to law school and renegotiate third world debt.
okay, that's great. Yeah, I mean, there's this rule where I mean, Jeffrey Sachs discusses this very much now. It says that, you borrow at a lower rate than what your economy is growing. You borrow, if your economy is growing at 4% GDP, your interest rate should be lower than that. And by accumulation through, if you have a 20, 30-year loan for productive investments in infrastructure industry, by 20, 30 years, you will have repaid many, many times, but you cannot pay 6% or 11% interest rate on loans, which are only 5 years maturity, with a project will mature in 20 years, like railways, power plants, or so
Yeah,
these are the things which people don't really understand and think about. Even people in government, I talk to economists, parliamentarians, have no idea how these things work. They just follow the media. And I'm really grateful that you present these things in your book. And we would, of course, people can order the book. We will have a link to where they can get it. You can show a copy there. Yes. And so people can order it. And just to conclude, we believe in, that there should be a way for coexistence between the West and East, between North and South. We don't believe in a split world. We don't want a new Cold War. We don't want China to defeat America, or this is not what we want, the world of peace and economic development, but we need to learn from the lessons. So I just finally want to ask you, what is it that scares you most, and what is it that gives you most hope?
okay. Um, Obviously, what scares me most is that we're seeing a lot of aggression and war in the last 2 years, 3 years, and it doesn't actually make any sense except as a projection of hegemonic power. That there's a belief that if the United States could control all of the oil of Venezuela and Nigeria and Iran, then it can, those are 3 huge reserves, and then it can sort of choke China because it can stop China from getting oil from Iran and Venezuela as it has done, and cooperating with Nigeria as it has done, as you say, on the refinery to get Nigerian oil. And that way, the United States can remain the hegemon by choking China. That's obviously what it wants to do. But in terms of optimism, what gives me great optimism is the very rapid change of attitude in the world to explore alternatives and to use technology in ways to build resiliency and to build stability, because you have other options than dollar, than having to surrender yourself to the hegemon. And so we're seeing enormous technological advances come out of China almost daily. You know, the DeepSeek moment last year. I love DeepSeek. It's great. I find it very, very rational. And there's so much wonderful technology coming out of China. The cost of solar power is now so low. Countries like Pakistan and countries in Africa are moving to solar as their preferred power because they can afford it. They don't have to build a huge multi-billion plant that requires upfront finance. They can import solar power, household by household almost, to really build it out and build out capacity. And that has enormous capacity to change the economic dynamics in isolated and poorer parts of the world. So I guess what scares me is the hegemon is becoming unpredictable. What gives me optimism is that the technology is also rolling out at scale in ways that can mitigate the risks.
Yeah, I know people are waking up to that reality all over the world in a certain sense, but we still have a problem. People getting out of the old system, and like in the Hamlet case, walk new paths untrodden before, and realize that there is another world at the end of the tunnel there, waiting for us with a much more optimistic prospect. Well, Kathleen Tyson, thank you very, very much. It has been wonderful talking to you, and looking forward to further discussions in this year, 2026. Thank you very much.
Thank you.